Welcome to the SPX options trading series by alphacrunching.com. Now let's get into the video. All right, so we are logged into alphacrunching.com and I've chosen the current week. This happens to be the week of December 19th, 2022. These charts are available before the week begins because they are forecast charts, and we're going to look at the daily chart. When I look at the week of December 19th, Monday daily chart, we're going to see that we have a pretty bearish bias for most of the day. And we start at 9:30 in the morning all the way to 4 p.m. So this is just for that Monday for this particular week. If I uncheck this, we can see we have the forecast for each particular day. And as the week progresses, we can look through different days, select multiple days. But we're going to focus on Monday, December 19th. And what I'm trying to do is trade in the direction of the bias or the forecast. I'm not going to get caught up in from 10:45 to 11, there was a little rally in the forecast. That's not what we're trying to do here. We're trying to get a bias so that we can trade in that direction, so that we can get at least one good trade, maybe two good trades for the day of trading SPX. If I flip over to the chart, this is the 1 minute chart of SPX. I'm going to talk through my first trade of the day. We still have a couple more hours. I may try to squeeze in another one, but it's pretty choppy. I have the opening candle. We can see it was pretty bearish. In this market, I've been letting the opening 20-30 minutes or so kind of open up, and just to kind of let the dust settle from the weekend and any news that may be able to come in. But for this trade, I let the market kind of open up. We did open up bearish, and then we started to get a retracement. And the general idea was I want to trade in the direction of the bias, which is bearish, and I identified 38.50 as a key level for SPX. A lot of times these quarter strikes like 3800, 3825, 3850, 3900, those 25-point increments, we also call them the quarter strikes. Those can be key levels. So as the market rallied back up to where it opened, right? This matched the key level, which is 38.50, and yeah, it kind of chopped around. And some might interpret this as a bull flag, and that's something you have to contend with. But what I ended up doing is, while on this particular candle, I opened up a 0 DTE where I sold the 38.55 call and bought the 38.60 call. So my short strike is at this level. And the idea here is that, because we're bearish, we don't think the market's going to get above that. So even though I thought 38.50 was resistance, obviously things can chop around a little bit, give or take a few points. So this trade was opened at, the entry was at 10:21 a.m. So at 10:21 a.m., I sold that spread. And again, from the SPX weekly options blueprint here, I'm not really concerned about 10:21. 10:21 a.m. is like right in here somewhere. This is 5-minute increments. I'm not really worried about these little kind of turning points because these are not significant. The significance here is that overall we're looking at a potentially bearish day, and I'm looking for that confirmation. And so when I sold that spread, I don't want to, the time of day isn't as important to me, other than we got the retracement. Technically, we're at a key level. We're at the opening candle. So I sold the spread. And about, I think it was 27 minutes later at 10:48, I was able to buy the spread back for $1.30. And so this is about 35% of that max profit in 27 minutes. Now, I did a recent podcast episode. If you haven't seen it, heard it, the Stock Market Options Trading Podcast, where I talked a little bit about when to take profits. It's called Profit Taking Concepts for Credit Spreads. And this is another example of that where, if I sold the spread for $2, the most I can make is $2 or $200 per spread, and I'm risking $3 per spread. Well, if I can book a decent amount of this credit in a short period of time instead of holding it all day, I'm going to do that. In this case, I got 35%, and let's call it 30 minutes or so. But there were still, 5 or 6, maybe 4 or 5 hours left in the day. So yeah, I could have held on, and obviously the market ended up dropping lower. I'm actually going to look at re-entering here at some point, but the market did drop lower, but that's okay. I booked a decent profit in a short period of time. I'm being rather prudent in this market given the potential for reversals and all that. So again, the general framework or setup for this trade was finding a decent bias. And this day, there's actually a pretty good bias. Let me look at some of the other days. Some days aren't as active. You see, like a day like Wednesday, this this is very, very choppy, and you do get a push at the end of the day. So, it's hard to pick a bias on these days. So you either have to trade something else or be patient with that analysis. Thursday, again, this is very choppy. Maybe you can get a morning trade, but I like the I prefer a trending day like this with some kind of chart confirmation. In this case, trading off key levels and selling credit spreads outside of those key levels with the idea that it should stay lower. And as we see where the market's going, now we're kind of in a range bound. So if we rally back up, I may look to re-enter. We'll see. But that's what I got for this trade. Thanks for watching, and we'll see you in the next video.